Hello. In this video, we'll talk about what adjustments are and why accounts record adjusting entries. Many of the accounting entries that accountants record are related to transactions that are typically routine. Purchases from vendors, paying employees for their services, selling merchandise to customers, billing customers for services. But there are some accounting transactions that are not related to those types at all. These non-routine entries come up due to internal operations of the firm during the accounting period. Typically, when accountants want to close the books for the month to understand how much the business earned in net profits, they need to make those adjusting entries to either reflect unrecorded entries or to adjust entries that were already recorded. In this chapter, we cover some basic adjustments, such as adjustments for prepaid expenses, depreciation, and supplies inventory. And then expand on adjustments later in chapter 12 when we'll discuss accruals and deferrals. Rather than immediately record adjusting entries in the general ledger, we enter them first into a schedule called the worksheet. The worksheet provides a very convenient way for the accountant to gather all the information in terms of the trial balance, the adjustments, and to determine the effect that it will have on the financial statements. But don't worry if this sounds confusing. We'll take a look at adjustments and the worksheet step by step by reviewing the adjustments we need to make for Eli's Consulting Services on December 31st, 2021. For Eli's Consulting Services, there are only 3 adjustments we need to review for the December 2021 financials. There are many more adjustments accountants record, but for Eli's Consulting, we'll only talk about these 3 at this time. The first one is related to supplies that were used up in December for $500. We also have prepaid rent, and we need to record the rent expense for December for $4,000. And in addition to that, we need to record the depreciation for equipment that was purchased. So what's depreciation? Well, it's a process of taking the cost of purchasing the asset and dividing it over the expected time that the asset will be used for the business. There are several different ways to calculate depreciation, but we won't cover that right now. For Eli's Consulting Services, we'll use the straight line method of depreciation. And this straight line method of depreciation spreads the purchase cost less salvage value in equal portions across the estimated life of the asset. So just in case you're wondering, salvage value is the amount that you expect to sell the asset for at the end of its life. Now let's talk about the estimated useful life. There are different ways of calculating the useful life, but there are also guidelines that are issued by the IRS. Now let's look at this example. We have a purchase price of $10,000 for, let's say, office equipment. We estimated that we still get $500 for it at the end of the equipment's life, which leaves us with an amount to depreciate of $9,500. We divide the $9,500 by the useful life, which in this example is 5 years, but it could be 7 years, 12 years, or longer for other types of assets. So for our example, we divide 9,500 by 5 years to get the amount of depreciation per year of $1,900 or $158.33 per month. The system of recording the depreciation each month is supposed to reflect the loss in value of assets over time. Is it an exact method? No, not necessarily, especially if you think about how quickly a car loses its value in the first year. However, businesses do not want to check the value of their assets every month and then record the loss in value. So depreciation is a good method to reflect the loss of value in assets that the business owns. One more thing, generally accepted accounting principles require that the original cost of long-term assets continue to appear in the asset account until the asset is disposed of either via a sale or thrown away. That means that the depreciation we record does not reduce the asset account directly. Instead, we'll use a contra asset account called accumulated depreciation so that we can see both the original purchase price of the asset and the depreciation we've recorded since the purchase. Before we start recording the adjustments in the worksheet, let's look at our worksheet again, and specifically the adjustment column. Just like the trial balance section has a debit and a credit column, the adjustments section also has a debit column and a credit column. And it is into these columns that we're going to enter our adjustments. The very first transaction is related to supplies. Eli's Consulting began the month with $1,500 in supplies. How do we know that? We can look at the trial balance column, and we can see that the supplies account is listed with a $1,500 amount in the debit column of the trial balance. At the end of the month, $1,000 worth of supplies are remaining, which means that Eli's Consulting used up $500. We need to transfer $500 out of the supply account to supply expenses. The business could record an entry each time somebody took supplies out of the supply cabinet, but that wouldn't be very efficient. Instead, the business counts at the end of the month how many supplies are remaining in the cabinet and then figures out how much was used by subtracting the ending inventory from the beginning balance. So let's record the usage of the supplies. We do that by writing a credit amount of $500 into the credit column of the supplies account and a debit into the debit column of the supplies expense account. We're now ready for the next adjustment. All right, here is the next adjustment. On November 20th, 2021, Eli's Consulting Services paid $8,000 for the December and January rent. We recorded it as prepaid rent, and we can see the account prepaid rent showing $8,000 in the trial balance column. December is now over. At the end of the month, we've used up the rent, and we need to record it as an expense. We do that by transferring $4,000 of the $8,000 to the rent expense. We do that by writing a credit into the credit column of the prepaid rent account and a debit into the rent expense account. Now we're ready to record the depreciation for Eli's Consulting equipment assets. Eli's Consulting purchased equipment in November 2021 for $11,000. The useful life is 5 years, and the salvage value is 0. There are several methods to calculate depreciation, but Eli's Consulting Services uses the straight line method. So to record the depreciation for the month of December, we subtract the salvage value, which in this case is 0, from the cost of the asset, leaving us with $11,000, and then dividing that amount by 60 months, which is 5 years. The amount of the depreciation is $183. As I mentioned previously, depreciation is not recorded directly as a reduction to the asset account. Instead, we're now using a new account called accumulated depreciation equipment, which is also called a contra asset account and has a normal credit balance, even though it's an asset. An additional term that is often used in connection with assets is the book value. The book value is the net asset value after depreciation, which means that you take the original cost of the equipment and you subtract the accumulated depreciation from it. In our case, it is $11,000 minus $183, which equals $10,817 of a book value. Let's now enter the depreciation into the adjustment column of our worksheet by debiting the depreciation expense equipment account for $183 and crediting the accumulated depreciation account for $183. Did you know that some accountants only focus on fixed assets? Fixed asset accountants are responsible for recording the purchase of the business's assets, recording depreciation, tracking the assets, performing asset inventories, and recording disposals. Some businesses have huge teams just for managing fixed assets. As I mentioned at the beginning, accountants record many more adjustments than just the three we talked about here. Later in Chapter 12, we'll cover accruals and deferrals and learn more about adjustments.